Thanks again, everyone. Thank you. Yeah, thanks for spending your very precious Saturday morning with us, especially coming all the way here just to eat youtiao. But hopefully it tastes well. Anyway, we're going to have it a little bit different. So to start off with, we're going to have our credit analyst. You just give maybe a 10 minutes update on just the bond markets and so forth. I'm going to hand it over to you. But before that, I'd like to wish everyone, everyone online and offline, a very happy, healthy 2024 and hopefully for everybody. Okay, so I'll hand it over to Sean. He'll discuss about bonds, then we'll pass it on to the usual equity session. Thanks, everyone.
Next slide. Yeah. So hi everyone. Thanks for coming down today, like mentioned by Paul. So I'll be running through on the rates action, the current rates, and I'll be roughly running through the rates environment as well as what is the outlook, and also touching a little bit on the local treasuries direction for Singapore government securities. Yep. So next slide. Yep. So as you can see, for the first topic, it'll be on our current interest rate environment as well as the outlook itself. So first, looking at this graph, this is the dot plot graph that was released back in December, which is in the summary of economics projection for the federal fund. So as you can see in the first column, right, all of the members, which is 19 members, have expressed that the interest rate is at a comfortable level of 5.3%. And this is within the range of 5.25 to 5.5% as of current. So for our current, for the federal fund rate, currently is hovering at a rate of 5.25 to 5.5% for the past 3 months already. So if you were to look at the second column, which is for the year of 2024, I'm not sure if you can see, which is this column down here. So the federal committee has expressed that for interest rates, it will be falling towards the range of 4.6% for this year. So from the current rate of 5.25 to 5.5%, all the way to 4.6%, it will roughly translate to a 75 basis point cut. So for 75 basis point, it will be roughly around a 325 basis point cuts for this year. And subsequently for the following year, then the interest rate will start to falter even lower towards the targeted range of the 2%. Yeah. So moving on. So yeah, this is the Fed Funds future curve, which illustrates the market expectations for interest rates for the following months or even further. So as you can see, right, in January this month, the market is expecting the rates to pause at 5.3%. However, for the market is expecting interest rate to fall to a level of 4% this year. However, like I've mentioned earlier, in the SEP that Federal Reserve had released back in December last month, they're expecting interest rate to fall to 4.6% and not 4%. So market is expecting a 150 basis point cut for this year, which is way more, which is almost 2 times of what the Federal Reserve are expecting this year. So personally, I believe that the market is slightly optimistic as to them pricing at 4% for this year. However, why do I think this? They are slightly optimistic would be on the next slide. So yeah, as you can see, these two graphs are the US CPI as well as the US PCE. So these are the two, I would say, main indicators that the US government are looking at in order to measure their inflation. So as you can see for the US CPI, right, currently it's trending at roughly around the 3% range. And if I'm not mistaken, I think the latest CPI release for December was at 3.4%, which is slightly higher than market expectation of 3.2%. So I mean for US CPI back in November's release, it was at 3.11%. So there's an uptick of roughly around 0.3% right there for CPI index. Whereas for PCE, PCE is also trending down. So in general, as you can see for either US CPI as well as their PCE index, right, inflation is indeed trending down. However, it is not trending down as quickly as what the Federal Reserve are expecting, as well as there are a few instances whereby the Federal Reserve have mentioned that more concrete evidence are required in order for them to have much more confidence in implementing a rate cut, because they do not want to do a rate cut too prematurely, then unwinding their efforts being made back in last year. Yeah. So moving on, next I'll touch a little bit on, so if interest rate were to fall for this year, then how would this impact or translate to our local government securities, which is roughly quite a hot topic back in last year as well as the year before. So for this graph, right, it's the 6 months Treasury yield curve for our MAS T-bills. So as you can see in this graph, the yields have been rising since October 2021 all the way until 2022 of December last year. So not last year, but 2022 December, sorry. Yep. So as you can see, from then on, right, rates has been hovering around the range of roughly around 3.6 to 3.9%. So this was because the rates have been climbing. However, for our 6 months T-bill is slightly laggish. So for rates moving forward, because rates are expected to cut at the later half of this year, this would translate that for MAS 6 months T-bills, our yields will be range bound, which I believe it will be around 3.6 to 3.9% as of current, all the way until where Federal Reserve have much more concrete evidence saying that inflation do indeed coming down and indicating that, you know, a cut might happen soon. Then we'll then be able to see that rates will start to fall slightly a bit, yeah, for our 6 months T-bills. Yep. So in the next slide, yeah, so for this slide, right, it's just a rough indication on the directions on how our government securities and the Federal Reserve rates are. So as you can see, there is some correlation, but it's not 100% correlation. So as you can see, as the Federal Reserve rates increases, our Singapore government securities are increasing as well. However, if you can see in 2023 onwards, our Singapore government securities are starting to hover around, like starting to be range bound, whereas for the Federal Reserve rates have been, yeah, on a consistent basis in July onwards. So for this year, I would say that for our Singapore government securities, it will still be range bound. However, if you were to take notice on the 5 years and the 10 years, which is the purple and the orange line, although for the 1 year as well as the 2 years, it's slightly range bound, but for the 5 years and the 10 years, it's deep slightly further. This is because, like, for the 5 years and 10 years, it's slightly more sensitive to interest rates, hence the larger movements. So yeah. So one question I usually get from our clients is, should I go into T-bills or should I go into fixed deposits? Because back in, I think, 2022 as well as 2023, T-bills as well as fixed deposits were giving quite a relatively competitive yields. So, however, yields for fixed deposit has came down quite significantly. So as of current, right, for the 6 months and the 1 year T-bills, they are offering around 3.7%, whereas for our local banks, DBS, OCBC as well as UOB, for their fixed deposits, they are offering around 3.2% for almost a similar duration for the 6 months to a year period. So if you were to ask me, should you go into T-bills or should you go into fixed D, then I believe that, you know, for investors that have idle funds at the current moment and they want a relatively safe and not sure where should they park it at, then I think the better investment choice would be for 6 months Treasury bills, as well as the 1 year Treasury bills. So why is Treasury bills why is short-term yields slightly higher than our longer-term yields, let's say securities as well as bonds at the moment? Yep, so this is a graph of the US Treasury yield curve. So this is an overview. As you can see, right, currently the 6 months as well as the 1 year are slightly high, offering a higher yield as compared to the 2 years and the 10 years. So yeah, so currently, as of current, the Treasury yield curve, no, the yield curve as of current is inverted at the moment. So like I've mentioned, I think in terms of positioning wise, I think right now you're still able to lock in, okay, you're still able to capture the attractive yields for short-term investments. Whereas until when yield starts to fall, no, when rate starts to fall, then you'll start to see the yield curve starts to pick back to a normal trend of an upsloping curve rather than inverted curve right now. So yeah, this is also an overview on the Singapore government yield curve. So like I mentioned earlier, the 6 months and the 1 year is offering around 3.7% as of current, whereas the 2 years and the 10 years is offering around 3.22 to 2.79%. So for our strategy in terms of, for fixed income, because rates are expected to hover slightly longer, while the Federal Reserve wait for more meaningful data pointers to provide them with more confidence for rate cut this year. For the shorter term play, we believe that Treasury notes are still fairly attractive, although Treasury notes yield have been coming down slightly around, I would say around 80 basis points as compared to last year. However, they are still offering I would say roughly they are still placed in a rather attractive position right now because they are first, in terms of duration, they provide short-term duration risk, as well as the yield they're offering right now is slightly attractive as compared to longer dated bonds or longer dated securities. Hence, for our short-term play, we would like to take advantage of the inverted yield curve as of current. And some questions I may get is, what if, for short-term securities, let's say after 6 months or 1 year, I may face the reinvestment risk. Then I believe that once yield curve have returned to normal and rates have started to taper down, if let's say you're not really, interested in fixed income space anymore, then perhaps you can look at other investing opportunities such as let's say stocks or. Then the last point I would like to share is for investors who are interested in fixed income space, then I think right now it'll be a good opportunity to add some durations into your fixed income portfolio, because right now bonds are issuing at a roughly high coupon rate due to the current yield environment. So once rates start to taper down in the following year or so, then the bond price will start to increase, will start to rise to reflect the yields that are coming down as of current. Yeah. So with that, I'd like to hand over the time back to Paul and his team to share on stock picks. Thank you.
Thanks so much, Sean, for giving us an update on the fixed income. Okay, let me remove this Ivanti. Okay, so I'll just run through our Singapore equity strategy for 2024. As you can see here, when we did our strategy, as what we're trying to say from the message here, our AI generated image is that even if there's a bear market coming, because we think the US growth is going to slow, the Federal Reserve has got your back. So Federal Reserve is going to support any growth. So we still think the US is going to enter into a slower growth environment in 2024. But asset prices will be protected by interest rate cuts. That's a basic nutshell of it. Next slide. Usual disclaimer, you still have to go through another very small font, nobody can read, but let me just summarize for you. These are our views. We may change our views, but we will let you know. You won't keep quiet. And also, we rely a lot on public information, and our views do not take into consideration each and every individual's financial needs. Feel free to refer to your financial advisor. Next slide. Okay, I'll just run through what is the content that we'll do. As usual, we'll start off with a review of what happened in 2023 very quickly. We'll run through macro themes. So macro themes is not about trying to bore everyone, but it's mainly just to give you a rough roadmap of what we think is going to happen into the macro environment as you invest into 2024. Then my colleague here, Zain, will go through technical pulse. He'll just give you 3 picks: small cap, large cap, and from our model portfolio, what he likes the most. We will have sector trends, what we think about healthcare, banking. We'll have our usual stock picks. We cover a lot of stocks, but we try to narrow it down to just our model portfolio and recent initiations. But feel free to ask us any questions. Then the last one, second last, is recent initiations. And then we'll just end it with a conclusion. In case anyone slept through the whole event, at least you just listen to the conclusion, which is probably 3 points. Shouldn't take a nap then. Okay, hopefully I'll wake you up. Okay, then let's move on. Okay, so for review of 2023, as the picture suggests, the bull and bear also fell asleep. So basically, a lot of noise, but in the end, the market just went 0.3%. In Singapore dollar terms, it just went nowhere. But of course, there's a lot of volatility and noise. Okay, so we're just going to run through some of the large cap names, the movements. Banks disappointed. So banks is like 40% of the index. Where the banks move will depend where the index moves. So the banks was actually, so OCBC did the best, and then the worst was UOB. Even though the bank's earnings rose about 30%, dividends up 40%, but the market said, no, that's not good enough for me. But anyway, although in the US, the earnings came down, but the share price just rallied. The one that did the best was really the conglomerates. The Sembcorp, I think over the last 2 years, it doubled the share price, and Keppel Corp, because there's been no power plant over almost going to be almost a decade since we had a new power plant. The last power plant was High Flux. Hopefully nobody heard that, but the last power plant was High Flux in Tuas Spring in 2016. And we have none, and they've been shut down. So capacity came down a lot, and that's why power prices, margins for electricity went up, as all of us know. And as a result of that, the only new plant that's coming up is only 2026. So there's still some upside for conglomerates because there's no power, there's no supply, and demand keeps on rising. The worst index performers, Hong Kong land, because office, even in central Hong Kong, the vacancy is 9%. You know, vacancy in Singapore is about 1%. You probably can't find space in the central CBD, but in even central Hong Kong itself is 9%. Could be climbing out even more. Of course, Thai Bank, I'll elaborate later, and Venture got kicked off on the index also, I guess. But I just left it there because it's one of the worst performance. From another index, the MSCI index, right? Then industrial REITs did very well. Which I'm a bit suspicious because how are they going to avoid the economic downturn? But anyway, a lot of them have data centers, so that helped a lot, which I think I ask my colleague later, Darren. Next slide. Okay, this is my last slide for performance, so don't have to dwell too much on the past. But as you can see, this is US dollar terms. The best performer has been the US. So actually, it clawed back the losses. So the blue is 2022. So 2022, Singapore outperformed. We were like we could go out there and shop with the best because we were up 4%, better than the rest. I mean, not like fabulous return, but all this before dividends. So you probably could get a 10% return for Singapore market last year, but we outperformed everyone. 2023 was, we were up in US dollar terms only 1%, but the rest really outperformed. I think you can, this is just for your reference, if you want to have a sense of what happened 2022, 2023. Of course, commodities was one of the weakest performing asset classes. Next slide. Okay, so these are what are the macro themes. Hopefully it is a bull macro theme, but let me just run through. Next slide. So the first theme will be, we still think US will enter into a sluggish growth period. Not only US, the whole world. So Europe is probably growing 0% if you're lucky. Then we think US is going to slow. And then China is also very sluggish, because of structural issues like property and so forth. Next slide. So before we start, we do a report card of how were my predictions. The dash miss was a wrong prediction. Of course, plus 50%. I cannot be a scholar with this type of 50% pass, 50% passing rate, but better than flip a coin. But I mean, we're on par with flipping a coin. But anyway, for 2023, we thought inflation peak, okay, that was right. But we thought there would be a mild recession. I'll explain why that didn't happen. Instead, the US growth was more resilient, and interest rates modestly rise, they did. And then we thought a rebound in China, but it didn't. So this is our four, so you can assume that statistically 2 will be wrong. Okay, but hopefully all 3 like this. Okay, I can't be all 4 right because I'm not a scholar, so I can hopefully 2 right, then at least can still pass. Next slide. But of course, on a more serious note, just to let you know that things change. These are predictions. So things change, and our macro forecast will change as time moves on. So just to give you a broadly what's happening, exports very important to Asia, Singapore. So there is a recovery. You can see from the bottom, exports starting to bounce. But what we think is that you can see there's an arrow there. It's not some random arrow that I put there, but it's just to show you that we don't think you're going to get this big surge in exports. We think exports will probably just be very modest, low single digit. Why this is important, this will frame our view for electronic sector. Next slide. And one of the reasons why we are not positive on electronics is because of this chart, because demand is still very sluggish in the US. So this retail demand, you get inventory swings and all, like 2023 was very bad because there was too much inventory, then there's too much inventory in the store, so there were no orders for venture or whatever. I'm just picking a name. But when you stock up the inventory, then obviously you will get demand, but it doesn't mean demand is strong. It just means that you're just filling up the inventory because it went down so much. But we think that US is still going to be very sluggish, and you can see from here, we think it's just be very sluggish, and that's why it's not going to be very positive, we think, at least for electronics. We shall have a chart later on semiconductor. Next slide. And then, of course, if you do read the newspaper, I don't really watch a lot of YouTube, but if you do read the newspaper, you see that there's a lot of news about US jobs doing really well. But if you split it between economic sensitive, that means jobs that are in finance, technology, manufacturing, is actually sliding down. So what is giving the nice headline numbers in US or 200,000, 300,000? It's mainly government jobs, and that's not economic sensitive. I mean, the economy could be in recession, they're still going to hire government jobs, still going to healthcare, social, nothing to do with the big economy. So that's why we think that beneath these employment numbers that you see, actually there is weakness in the US economy. If you just look at the red line itself, hopefully it doesn't go until this is another pandemic, but the key thing is that it is sliding. Next slide. Okay, and the other thing is also the savings. So why the US has been so resilient, the US consumer, although everyone thought 2023, there was an 80%, most economists thought that there was going to be a recession in 2023, but it didn't happen. Mainly because of this, there was a lot of savings. The government gave so much that everyone, if you do from a top down, almost 2.1 trillion of savings. But this is starting to come off and to almost 300,000. So this is going to be a drag for next year because your savings is down. How we calculate this is basically, you do like a trend line, how much they should save, and then, but they actually had so much, like you're supposed to put only $10 in the savings, but then during this time they put like $20 in savings. So obviously a lot of it came from the stimulus. Next slide. So that's one reason. So the second reason why US did very well was mainly on this chart. So right now, a day job, not only just look at Singapore budget, which is like every February once a year. I also had to actually monitor how the US budget is. Not like I've got nothing else to do, but the reason is because US government spending is now half of the US GDP. So US GDP probably is going to grow maybe 7% roughly, nominal, but one half of it comes from government spending. So the government is contributing to all the growth. Half the growth, sorry, not scholar, but I mean half the growth, so like 50% of the growth. So you can see from the deficit here, this is the increase, this is the net change. So you can see that the deficit increased by almost 1.3 trillion, by 2.3 trillion increase. So this is like 3.5% GDP. This is net change, this is not the total. So what we think next year there's going to be a big drag because the deficit won't be so much anymore, because there are a few very technical things, just to bore you again, but a lot of it was because the income tax in the US came down a lot, because there was California deferred taxes, number one. There was still some additional taxes that you could get from pandemic. But anyway, a lot of these are one-off. So we think as we end, and also social security spending went up because inflation is up. But we think this will be a drag to US economy too, because the government deficit won't be so much. So when the government deficit isn't as high as last year, it's going to be a drag on the economy. Next slide. Okay, this is the other one. So in the US, I think we highlighted this before in the previous. This net increase. So they spend like 1.3 trillion to give all the retirees. Now, I think mostly maybe one in four retirees, 3 in 4 or half of all retirees or more get a social security check, average about 2,000 US. So this is on autopilot, and nobody can stop this unless you don't want to be a president. But so what happens is that they got a big jump, 140 billion. So we just think that this is going to be a drag. I mean, this is a bit technical, but just to tell you, these are some of the reasons why we think US was slow. Okay, next slide. Okay, then the other thing is not only the consumer we think was slow, it's also the corporates. So this is new orders. So this is like orders for machines, excluding defense, excluding aircraft. I'm not very technical, but basically this is whether the corporates are spending, and that is also starting to decline. We think because interest rates are high, and of course there's a lot more cautiousness. Next slide. Okay, and of course, we just have a quick look at China because China used to account for 1/3 of global growth. We think China is also slowing down. So one of the reasons the big problem for China is the beige line here, which I think nobody can see, but if you can see the beige line here, that's the private spending. So in China, as you can see from 2008, China's growth was all about fixed asset investments. It was everybody was just investments. And just look outside, you can see all the cranes. I'm exaggerating, but China was driven a lot by investments. You can see it used to grow like 50%, 30 to 40%. But right now, the private sector is not spending. So that's the issue right now, because it could be confidence or whatever. So that is the one that's dragging the Chinese economy together with the private property. So the reason why we bring this up, because China is such an important. So with US slowing down and China moving sideways and Europe, 0% growth. So that's why we think, as a roadmap for all investors, we just think that you should expect 2024 to be slower. Next slide. Then, of course, like my colleague Sean mentioned, rate cuts are expected. This will be the one that's going to hold the market. Next. So, okay, so this chart is, again, not to confuse everyone and give everyone headache, but so this chart is actually very important. This chart actually caused the REIT market to drop almost 4% in 1 month. So, okay, so if you look at June, so June was where people thought, the red line was where people thought interest rates are going to be. Okay, so that's why everybody was happy with that. Then in September, the Federal Reserve, that's the green line. Then in September, the Federal Reserve said, no, I think I won't cut so many. I'm only going to cut 2 times or about 2 times or maybe 3 times in 2024. Then that caused the big swing in September. That's why the REITs dropped very significantly. And then in December, they changed their mind again. And then now everyone thinks they are looking at 5 rate cuts. And you can see the blue line. So this is right now where the market expects. Why this is important is this swing that you see here, these lines actually cause huge volatility in the REIT market because people do not know where interest rates are going to land. But right now, the market is looking at 5. I'm looking at 2. Fed is looking at 3. Okay, so I don't know who's right, but I'm probably going to be wrong. I mean, 50-50. Next slide. And the most important thing for us is like why we think interest rates is going to be low. So you can have all kinds of forecasts out there, but most important is to measure the condition. So what we look at to see whether rate cuts are coming is this chart. So most important is the core inflation. Core inflation means you take out fuel, take out everything. That's the underlying inflation. So based on the trend line, we think it could actually hit 2% by December. Again, this is just maths. So we think we have got there. So the trend line is still coming down. So there's a good chance that the Fed is going to cut their so-called 2 or 3 times, and mainly because housing inflation is coming down. Okay, but that's a bit technical. Let's move on next slide. And okay, this is another noisy chart, but what's important is the rate line. So the rate line you see here is the real interest rates. So when the reason why the Federal Reserve wants to cut, okay, not because it's an election year, but anyway, but mainly because they think it's in restrictive territory. What we mean by that is that the real interest rate, that means interest rates after inflation, you can see from here is one of the highest in a decade. So they think they are worried that this rate line is going to slow the economy, and it comes with a lag. It doesn't mean that you cut now, then immediately the economy can rebound. So they're worried that if I don't cut fast enough, they want to do it preemptively. So that's a very important word. That means they don't need to see the economy slowing, then they cut. Neither do they want to see interest rate really drop until very low, they cut. So they're willing to cut even before they see interest rate drop to their target. So that's very important messaging by the Fed, preemptively. And the reason is because of this rate line. Because if inflation keeps on rising, then this rate line is just going to keep on rising. So they don't want it to hold the economy back if interest rates are too high. Next slide. Okay, so this one is give you the headache one. So, okay, so having said all these interest rate cuts, so we want to know if there is an interest rate cut, like how does it affect the Singapore market? Okay, it's not like the Singapore market cannot make up its mind, but what we think is that, so how you read this chart is that that middle part here that you see, the 0, that's when the Fed cuts rate, the month that the Fed cut rate. Then how does the Singapore market perform after the rate cut? So ultimately, it depends on where the economy is heading. It doesn't mean that you get a rate cut. You see, even though you get the first rate cut, the market can still drop, like in the global financial crisis, September, the rate line. Likewise, if you see the January 01, the dot-com bust. So even though there's a rate cut, doesn't mean the market is just going to fly. well, it really still depends where the economy is heading. Like the one that did the best, I guess, is the March. You notice that after the rate cut, the green line, which I guess we all know, the pandemic, then the market got bullish because we think the economy will recover. Then the market can rally. So ultimately, it still depends on where the economy is heading. So it doesn't mean that rate cut means you pop champagne and the market will rally. It doesn't mean that. So this is just a chart, although it's a very noisy chart here for everyone. Next slide. Okay, this is my last chart, just to swing back to Singapore. I've been talking about the US so much. So we think Singapore is also going to be a below trend growth. It's still going to be also very soft. Next slide. In the manufacturing activity is actually picking up. So that's a good part. Next one. And structurally, Singapore is still doing well. We always like to show this chart because this is foreign direct investments into our country. And you can see most important is that, not that we are bigger than the ASEAN 5, but it's about us being higher than pre-pandemic. So you will see the blue line here. So we are collecting maybe 100 billion on an annualized basis, rolling 12 months. We're getting like 120, 130 billion of investments. So at least structurally, Singapore is in safe hands. And this is important. Not that we're a high growth market, but at least it supports the currency and it supports our so-called stability and safety, since we are probably the only AAA rated sovereign rated bond in Singapore. So that's why all these are important. That's for currency and so forth. Next slide. But things are slowing down, right? Just have to look at this. This is the amount of vacancies and so forth. This is just a quick snapshot to show you that the vacancies are coming down. So the job market is also slowing down. So just to reinforce the fact that Singapore will also be slowing down. Next slide. But one positive thing we got was the population. So we are not like Australia. Australia had like 500,000 net migration, and that's why the property market is so hot. But for us, we had like 200,000. But residents, but compared to pre-pandemic, where we used to get like 60, 70, we are like double, triple. So the resident population grew by about 80,000 in 2023. Pre-pandemic is about 30, so we are actually double that rate. It is good not for congestion purpose, but it's good because it's going to like support the property market and keep the whole economy vibrant. So it's a good number that population is actually recovering after the big wipeout in I don't know 2020 pandemic. Next slide. So with that, I'll hand over to Zain, and then the rest of the analysts will discuss about the sector trends.
Okay, thanks, Paul. I'll begin on the technicals. So I'll be sharing first the outlook of the Singapore market. Yeah, so this is the weekly chart for the ES3 ETF that actually tracks the Singapore equities. We can see that in these bolded black lines is the main uptrend channel that Singapore equities have been trading in. So this has been stretching on since middle of 2021. The uptrend is still intact, but for first quarter this year, I would think that we are likely to consolidate sideways still. So reason being that we actually broke down this uptrend support line, this blue color line, in October of last year, and we did a retest early on in this year over here. So I would think that over here there's also resistance around 3.3 to close to 3.4. So with that, we could see a little bit of consolidation first quarter this year, given that the banks are also likely to show some consolidative price action. Yeah. Okay, in terms of our large cap pick, I've chosen Seatrium. I'll explain why. Okay, for Seatrium, I would think that there could be another leg in the current uptrend. So reason being that some bullish signs have emerged in the chart. The first thing is that there was a breakout of this descending wedge pattern over here. This was back in December of last year. And following on, we have started to form an uptrend over here. Also, recently, the price has actually tested this price level at around 11.1 cents, which was a prior resistance level over here. And this also coincided with the 20-day moving average, which is this orange line. So previously, we can see that when a price came to touch the orange line over here, it acted as a dynamic support. And currently, we are revisiting this line over here again. So with the confluence of support over here, I think that the price could rebound to continue its uptrend over here, and potentially we could reach about 12.9 cents to retest swing high resistance back in the past. So this represents an upside of about 14%. In terms of our mid-cap, I've chosen UMS holdings. So for UMS, I think that the chart is generally quite nice. Currently, it's consolidating in this ascending triangle over here. But I think that this is currently a bull flag in the making. So once it breaks out of this $1.33 level, I would think that there's potential for the price to retest the all-time high levels at around 143 over here. So this could represent an upside of about 10% for UMS. Yeah. And overall, we can see that since second half of last year, the price has been forming a nice uptrend over here and forming a wave after wave of bullish price action. So I would think that it's possible for the price to retest the highs again. Okay, last but not least, I've chosen one stock from our Phillip Absolute 10 model, which is China Aviation Oil. Okay, why I think that China Aviation Oil is showing some bullish price action is because that it has broken out of this downtrend resistance line over here. So we can see that recently start of this year, we can see price that actually did a breakout and there was a positive retest over here. Another bullish thing is that there was also a range consolidation breakout over here, which is this purple rectangle. So with that, potentially the price could head towards about 96 cents to retest the highs formed in August last year. So this will represent upside about 7% from the current price level. Yeah. Okay, so that's all from me now. I'll pass on time to Glenn to talk about the banking sector trends. Thank you.
Thanks, Zane. Yep, so I'm Glenn. I'm covered the banking sector. So just be looking at the first slide here. This is just the basic NIMs against the interest rate. So we put both the Fed funds rates as well as the Singapore rates, so using the 3-month SORA. I think I'll just speak briefly about the SORA first. Interestingly, it was actually rising quite steadily until the most recent one where it dipped by a single basis point. And this was the first dip in like 11 months. So while the Fed funds rate was actually quite stable, it didn't dip, but Singapore's interest rates actually dipped slightly. So we are sort of expecting this to follow very closely with the Fed funds rate. So as I think Paul mentioned earlier, we do expect some cuts in this year. So the Singapore rates will most likely follow as well. And if you look at the orange line here, so that is the average NIM for all three banks. And you see there, for 2022, there was actually a plus 32 basis points. So it rose by 32 basis points. And in 2023, so against, I guess, most people's speculation, it will possibly also most likely increase by the same amount at 32 basis points. So this shows that the banks have managed to lower their funding costs and still sort of take advantage of this higher for longer interest rate environment. However, in 2024, where the rates start to drop, we do expect that it will start to dip slightly, but we're only expecting maybe a negative 2 basis points decline in the net interest margins. This is mainly due to the banks being able to maintain their funding costs. If you look at their current savings accounts ratio, it has actually been stable for the last couple of months as well. Yep. So moving on to the next slide. Yep. So just a quick recap on the three local banks results. So this is the 9th month of 2023 versus the previous year. And you look at the NIMs, as I mentioned earlier, the NIMs have all actually surged quite drastically. So it's around 38 to 50 basis points for all the banks. And net interest income, likewise, due to the NIM increase, has also risen quite well. However, just bring your eyes down to the loans growth. But the interest rates while it's beneficial for the banks, it's also a double-edged sword for them, because it means that while NIMs are very high, loans growth will tend to decline because rates are too high and the customers and consumers are less likely to take up loans due to the high rates. So you can see, coincidentally, all the loans growth for the banks have actually dipped by 2%. And I think another point would be the net fee income. So fee income is actually roughly flat if you take an average of the broader banks. And last but not least, you look at the earnings at the bottom box here. So the earnings have all risen, and this is most likely due to the higher net interest margins and net interest income. Now, moving on to the next slide. Yep. So one of the key points moving to 2024 for the banks would be the fee income growth. So the banks have all been talking about, they're looking at high single digit or maybe even double digit fee income growth in 2024. But where are they getting this from? You know, they have briefly mentioned it's from their wealth management. And some of them also say it's from credit card fees. So credit card fees, it's from things like the pickup in COVID, pre-COVID, post-COVID recovery. So travel expenses have increased for everyone. And also, you know, the numerous concerts that have happened, that are going to happen in Singapore as well. And the second one, which will be wealth management. So wealth management, the blue bar here is the assets under management, or AUM. So we can see, I put this all the way back to December of 2020. It was quite stable all on the way, all until I think the last 3 quarters, it started to rise quite rapidly. And you know, this is actually part on the banks where they actively go out and try to find this AUM to take in. However, if you look at the most recent quarter, while AUM has risen quite well, the fee income has actually dropped. And this might also be due to competitive pricing and the market activity as well. So they might be able to bring in the money, but they are not able to earn as much. So that's the reason why it's dipped. But going to 2024, we do expect that the AUM will continue to rise, and they will be able to, when the market activity picks back up, they're able to sort of recover their pricing and be able to get that high single digit or even double digit fee income growth, coupled with the credit card growth as well. Now, moving on to the next slide. Okay, so this is a rather confusing slide. Let me just explain what all these numbers are. So for the banks, they do have this. I mean, if you guys remember the SVB, Silicon Valley Bank case, where they had a lot of losses due to the bond prices dropping drastically. So Singapore banks are quite similar, but the difference is that they are more diversified. Hence, you know, the losses aren't as large and they are able to cope with it. So this fair value losses of their financial assets. So the financial assets would be like the bonds, majority of it's the bonds. So when the interest rates start to rise, the bond prices will fall. And you can see that from the first half of 2021 to the second half of 2022, they actually accumulated quite a large loss. But this all goes into their comprehensive income. Hence, we don't really see it in their profit and loss. So we did a sort of a rough calculation from 2021 to first half of 2023, where it started to pick back up. You can see that the cumulative loss in book value per share was around 60 cents to 90 cents. So what we're trying to say is that with the pick back up in the first half, when the interest rates start to dip, they might be able to recover some of these losses. And how is this significant for the banks? Yeah, this will, of course, they're not going to recover fully, like the 60 cents to 90 cents, but they could recover most of it. And this will, of course, boost back up their book value or equity value. Yeah, so that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. I'm Darren. I cover the REITs and property sector. Yeah, so first of all, for S-REITs, the 2023 performance is that they actually outperformed the STI by a bit, by 1 to 2%. So just look at this graph. This graph is actually the S-REITs yield dividend use spread. It's the forward dividend use spread over the 10-year Singapore government bond yield. So how you can read this is how much investors are being compensated for investing in the kind of the risky asset in S-REITs as compared to the risk-free asset, the 10-year Singapore government bond yield. So you see here, right now, the yield spread is about 3%. So this is historically, this 10-year historically is about -1 standard deviations below the mean. So it might not look attractive, but that's because the 10-year Singapore government bond yield is elevated. It's at elevated levels. Right now it's at 2.7%, and it is at kind of a high, even though it fell about 60 basis points from 2 months ago when the Fed signaled that they kind of expected, the dot plot expected that they have 75 basis points cut in 2024. But we do note that the forward dividend yield is trading at an average of about 6.5%, which is why forward dividend yield minus the higher dividend yield spread, forward dividend yield minus the 10-year Singapore government yield, which you get a lower dividend yield spread. But we expect this dividend yield spread to widen over the course of the year as the interest rates possibly drop further. So, and hopefully by the end of this year, we'll see this dividend yield spread creeping back towards the 10-year average. Yeah, which is the red line. Yeah. So next slide, please. Yeah, so this chart is the S-REITs index price to NAV for the past 10 years. As you can see right now, it really spiked up since the Fed came up, like mentioned earlier, they came out that they mentioned they expect 75 basis points of cuts this year. So after that announcement or after that Fed meeting, the S-REITs really just rallied. So you can see right now it's trading about 0.95 times. So this is now about -1 times standard deviations below the mean, and this is trading at around COVID-19 lows, which you can see over here at the 2020 levels. So we think this is an attractive point to enter the S-REITs market, because after all, it's trading at around it's trading around COVID-19's lows, which is the valuation at around 0.95 times. Yeah. Next slide, please. Yeah, so this is an interesting chart. This is the share price performance of the S-REITs index versus the federal funds rate, the Fed rate. So you can see that the top part, 18 September 07 was the first date that the Fed cut rates, and 16 December 08 is the date where was the last rate cut, as you can see in the first rate box over there. So what we're trying to say here is that it's not so much the Fed rate cuts that will drive rally in the S-REIT share price, rather is the expectations of the rate cuts that really drive the rally. So the first rate box you see when the Fed kind of the interest rates kind of flatten up or peak, we saw the S-REITs index really rally. So and then after when the Fed cut rates, we saw that the S-REITs index also kind of fell together with the Fed's interest rates. So you see there the 1 year performance from the first rate cut in 2007, it was down 40%, but then after the last rate cut, which was in 2008, you saw that the S-REITs rally 60%. So this is kind of a similar situation during the 2020 period during COVID. Like the first rate cut was part of the kind of the Fed pivot cycle in 2019, where the 1 year performance post the Fed rate cuts was down 7%, while after in 2020, when it was the last kind of the emergency rate cut for the Fed did for COVID, the REITs rallied 15% 1 year afterwards. So yeah, so I mean, the past performance is not does not indicate future performance, but as you can see right now, right now where rates kind of peaked towards the top of 5.25 to 5.5%, then if we expect it to follow what happened in the past, then the REITs will probably kind of rally a little bit until perhaps the first rate cut. Yep. So that's what the charts, this chart kind of explains. Yeah. Next slide, please. Yeah. So the next big thing for REITs is the gearing, which is we expect gearings to be affected, especially from the year-end valuations decline. So the biggest thing that happened in 2022, or rather in 2023, was the fact that Manulife breached their financial covenants, and we all know what happened afterwards. So the next thing that we need to take note of is how will 2023 year-end valuations affect the gearing for the rest of the Singapore listed REITs. So here I've compiled the list of REITs whose gearing levels are elevated above 40% and at kind of the higher risk of reaching that 45% level gearing or 50% MAS leverage limits if that interest coverage ratio is at 2.5 times. So for one example is Prime US REIT. Right now the gearing is at 43.7%. So it has about a 12.9% valuation decline buffer from year-end 2022 valuations for this year-end 2023 valuations for their gearing to hit 50%. So one thing to note is that if they breach the MAS gearing limits of 50%, it does not really signify any like significant breach. It just means that they cannot borrow any more money. They can only borrow to refinance their existing loans. And the big thing for them, for these REITs is that they cannot breach their bank covenants. Because if they breach their bank covenants, like the case of Manulife, then most likely the lenders, they can immediately call back their loans, and that will really impact all these REITs as they have to pay back their loans immediately. So that's the big one they are looking out for. So for example, Prime, like I mentioned, 12.9% valuation decline, and for Elite Commercial REIT, for example, they came up with their in December, they came out that their year-end valuations, it declined by about 9%. So that brought their gearing to about 49.6%. So that was very close to the 50% breach. And then a few days after that, they announced that they announced a preferential offering, and that they'll use the preferential offering proceeds to kind of pay down the debt. So that will bring down their gearing to about 43.5% post the preferential offering. Yeah, so this the list here, these are the other REITs that are at risk. But what we want to highlight is that the Singapore assets, the valuations are likely to remain stable. The biggest impact to valuations are likely from those from overseas assets where cap rates are expanding, especially the US commercial space and like UK assets and Australia and such. So we think Prime and Keppel Pacific Oak, Elite already came out with the year-end valuation. So Prime and Keppel Pacific Oak, which is here at 39.1%, are at the biggest risk of all the assets or the REITs that are stated here. Yeah, next slide, please. Yeah, so for subsector preferences that we favor retail for its potential for positive rental reversions. So this chart over here is actually the retail sales proxy for suburban and downtown malls. So how I compile this chart is basically the individual retail sales the retail sales categories, and then which are more prevalent in, let's say, downtown malls and suburban malls, and then I compared it separately. So as you can see here, the downtown malls, their retail sales index has been growing slightly more and as compared to suburban malls in the past few years, and this is comparable and it's in line with what CICT had in their most recent financial results, which was where suburban malls, the tenant sales grew by 3%, while the downtown malls, their tenant sales grew by about 6.5%. So what we're trying to say here is that because of this positive growth and tenant sales, as well as more international visitor arrivals and such, and as well as the occupancy cost, which is the rental income that these tenants pay over their total tenant sales. So which is now at around 15% for suburban malls and around 25% for downtown malls, which is about a multi-year low and is at very healthy levels. So all these factored in, we expect that the potential for positive rental reversions going forward for both suburban malls and downtown malls is still intact, especially downtown malls, where we expect the Chinese visitor arrivals to come back in full swing next year, or rather this year, especially with the 30-year visa-free travel. Yeah, so we are still quite positive on retail. Next slide, please. And for hospitality, we also favor hospitality because of the improvement in RevPAR. Year on year is still growing, and international visitor arrivals as well is still sub pre-COVID levels, about 10 to 20% below pre-COVID levels, and we expect this to continue to improve, especially with the amount of concerts lined up. It's like every other month you're seeing new artists coming to Singapore to perform, like major global artists, as well as MICE events and the Singapore Air Show, etc. So all these will help benefit for the hospitality subsector, and we expect RevPAR to continue growing forward as well. And one thing to note is that 2023, the hospitality subsector was the only subsector that could generate DPU growth, as the increase in revenue and which resulted in increase in RevPAR, which resulted in increase in revenue, could more than offset any rises or increases in interest expense. Yeah, so this hospitality subsector could generate DPU growth in 2023, and we also expect this to continue to 2024, where RevPAR continues to grow, and which will mean revenue will most likely continue to grow as well, and this could outpace the increase in interest expense. Yeah, next slide, please. Yeah, so for property, we are neutral on the property sector, mainly because there's a lot of supply incoming. Like you can see here, in the first half of 2024, there is about 5,450 more supply that's incoming in the government land sales program under the confirmed list. And this is the multi-year high, is the decade-year high, 10-year high since the second half of 2013. And this coupled with the about 11,000 more new launches that's coming up, we think this will cap the prices for these property assets. And the Singapore is still affected by the hike in ABSD. Last year, April 2023, we hiked the ABSD for foreigners to 60%. So Singapore is still affected by that. But the silver lining here is that perhaps when interest rates drop in the second half of this year, mortgage rates will start to come down, and then perhaps the demand may start to pick up for the property sector. So, but overall, we are still neutral on that because of the huge supply that's incoming. Yeah, so that's all for me. Thanks. I'll hand over time to Peggy.
Good morning, everyone. My name is Peggy. I cover three sectors today. My sectors will be very short. Okay, I cover the conglomerates. maybe your first question to me is, it's already gone up so much, like Paul has just mentioned. Is there still room for it to grow? Yes, we think there will be. The returns that you saw for last years were all total returns. So the capital actually capital did well because they distributed the KOM shares as well as capital REIT shares. But this year we think there's still more good news coming out from the two conglomerates, Telco and Keppel. Why so? Very simply, these two are the ones who are very highly geared to Singapore energy demand. So what they have been doing and they will continue to do this year is, for instance, for Sembcorp, they will grow their renewable capacity. They have been buying capacities, acquiring greenfields in the past, but now they go into even acquiring existing capacities in China, Vietnam, and India, taking advantage of the easier pricing now due to the higher interest rates. The competitive landscape has been reduced. So they are taking advantage of that to grow their renewable capacity to 25 billion by 2028. Okay. The one thing to note is their capacity is not offshore wind, not in the offshore sector. They're all the latest noises about these renewable sectors have been on the offshore sector, where you see the US major players have called off the projects because of the higher prices, and they're pressuring the US government to allow them to command higher tariffs. There's still unresolved over there. So that's the reason why we like SCI. We think renewable energy will become the major part of their earnings going forward. For Keppel, they have assets in their balance sheet and also in joint ventures, which they are going to park under funds under their own management. So the transition will help them generate recurring income while still continue to manage those assets. And these are a lot of critical infrastructure assets, very niche and very few players in there. So for Keppel, we think that this year they will front load this asset monetization in the first half of this year. So you'll see a lot more interesting announcements coming from them. And with that, they will create value in the balance sheet by lightening up the balance sheet, and then from then they could be able to distribute more to shareholders. So for these two reasons, we like the conglomerates. Okay, on the construction sector, actually Paul's kind of explained on my behalf already. If you remember his FDI chart, the foreign direct investment chart, the last 2 years we have been very, very strong foreign investments. So those will they usually convert into higher infrastructural developments in the Singapore market. So that is the one source of demand for the construction companies. The other one is the one on the left, the chart on the left, which is our housing, the homes. The government is very intent on building 100,000 homes in Singapore from 23 to 25. This is like double what the supply was in 2020 to 2022. So the ramp up housing development means that the contractors will be kept very busy, and as they start breaking the ground, start laying the foundation, the steel bars, they'll need a lot of steel bars. And then so we think the building materials people, the building materials players will do very well this year. The other chart on the right explains the outlook for this year and then for the next 18 months at least. Like for instance, for contracts awarded, whenever the award takes place, the work will start to be done in the next 12 to 18 months. So therefore, we think the earnings are coming through. The visibility is very clear. So we look at the spike rates on the right hand chart. Move on to the air transport sector. Okay, I realize I'm getting more and more like a contrarian here. Yeah, I still believe that we're probably having a very peak demand right now for the air transport sector, and competition and the slow recovery of corporate travels will actually see it falling off both for the traffic as well as the use. If you look at this table here on the right, the passenger revenue kilometer, not just for Singapore Airlines, across the globe, there's actually a lot of it that's generated by leisure travel. And leisure travels, it's not sticky, unlike corporate travels. So, and they're always the ones who can fall off, especially, so there's a very big seasonal swing for leisure travels. And then the other factor for leisure travels is you will then, a lot of them will travel on the low-cost carriers. So therefore, a lot of the revenue jump, the traffic jump has been in the low-cost segment. And low-cost, they don't give you food, they will want to turn around the planes very fast. So please get off as quickly as you jump on, and then they fly off again. So the turnaround is very important for them. So therefore, they require a lot of line maintenance, but the heavy maintenance portion is usually very cut short. In fact, for budget travelers, when they park when they land, and then during that short period of time, the maintenance people will go up there and visibly look through the aircraft and say, hey, yeah, it's okay. Then the captain will actually be the one to sign off the forms. Those for non-low-cost carriers, most likely it needs to be signed off with a certified engineers. So they will take longer. They will park on at the airport longer. So they make a lot more MRO. Sorry, to bore you with all these details. What I'm trying to say is that because these are low-cost carriers are just concentrating on carry people and flying them out, right? So there's all the fringe ancillary services that aircraft used to be able to enjoy, and then where they make the margins from, that part has been taken away. So the margins forward, we think is going to decline for the one unhappy things about these political conflicts will make it very difficult for them to. So if there's something happen in the Red Sea, you see they need to do this diversion or cancellation. So these are actions. And last week, the issues with the for Max 9. So what happened is the airline have grounded these kind of aircraft for checks. When the aircraft are grounded, okay, we might say, oh, it's United Airlines is that's got their planes grounded, but we can't think so short term, because the whole airline industry is actually competitive as well as independent. So if I want to fly to US on SIA, at some point on the leg there's a coach sharing, so that I actually find myself on another aircraft operating by another operator. So if this operator is down, which means my connection here is also affected. So in a way, the entire airline industry is disrupted. So this disruption is going to be fairly costly. It will not show in the December quarter results for SIA, but further down into 2024 numbers will be more evident. So for that, we are underweight on the aviation sector. Yeah, I'll pass on to Paul again. Thanks.
Thanks. If you want to know more about SIA, you can ask Peggy. First look at SIA when you IPO'd. So you're going to Google when they IPO'd. So if you want to know more about, for me not so long. So I looked like Singtel maybe since 2001. It was so for telcos. Just to give a big background, it's been really good the first 10 years now, up to 2010. Mobile penetration low. But then 3G came, then you got SMS. Then when 4G arrived, it was really painful. It was like really like waiting for paint to dry, root canal, whatever. It's been very painful for telcos. But this time around, what we think is that there is finally going to be a recovery, we think, for mobile operators. And why this is important is not so much for Singapore, but at least for Singtel. So you will know that Singtel owns a lot of associates in Thailand, in India. Okay, there's a wrong spelling, Mr. I, but there's India and also Indonesia. But the key thing is that what we are beginning to see after so many years is that prices are starting to climb up. And there are mainly two reasons why price climb up. Is because there's been consolidation. Like Thailand, there's only like 2 operators, virtually 2 in India. So after so many years of fighting and beating up each other, they finally consolidated. That's number one. The second thing was the cost just went up. I mean, electricity cost. The cost was just so punishing that eventually they also had to raise price. So that's why you can see from this chart, you're beginning to see it's a bit more prominent for the green line for India, but you also begin to see Indonesia starting to raise price. Thailand is a bit slow because if the economy is slow, then you try not to raise too much because you're prepaid. So it's a bit discretionary item. But we think across the board, even in Australia, also Singtel also beginning to see some price increase. They call it price repair. I don't know, maybe it's politically better, but it's actually price increase. So that's why we like telcos, because we think finally the mobile price repair is underway. Next slide. So for healthcare, many stocks are probably just Raffles Medical, because IHH, there's no volume unless you trade in Malaysia. But for us, we think healthcare is a long-term structurally strong. I think if you look at this chart, so this chart is the number of people aged 65 and above. Okay, mine is somewhere a bit further to the right, but also in that box, it's also going to be in that box. So more and more the aging coming is rising. So of course, there's going to be more and more demand for healthcare. So structurally, that's a positive. Then the chart on the right is actually 65, 85, but that's easier to remember. So like 60, 65 to be exact, but actually 65 used to be the life expectancy in the 70s, but now it's 85. So longevity means there's also means more healthcare needs. So all these are very strong structural growth drivers for healthcare. But that's on the top down. But from the bottoms up, there's a lot of cost pressure because like Raffles Medical, probably the next 1-2 years earnings is going to be quite big. Mainly because of the strong Sing dollar, not many foreign tourists are coming here for medical needs. And secondly, there's just a lot of cost pressure. You can imagine. And also the third thing is there's also government policy. Healthier FG means, like we mentioned before, it's healthy for everyone, but the hospitals and the GP, because they're going to press down costs. The only reason why you do healthier FG is just to press costs, and it's not going to be good for the healthcare sector. So long-term structurally strong, but just that in the near term, we think there's a bit of weakness. Next slide. For consumer, okay, so consumer, you can see I put ASEAN chart because Singapore consumer is mainly a Thai bev that's the main ASEAN, and the Monte and Food Empire, there's a regional presence. But it has been really bad for consumer, mainly because of inflation. Because inflation, you can see retail sales is coming down, and these emerging markets, inflation hits you 2 ways. A commodity price go up, then all the costs, and the exchange rate also hit you the second time. So that presses a lot of disposable income in all these emerging markets. It really dawned on me, I think I mentioned this before, but when I listened to Sabeco, so Sabeco is the largest beer company in Vietnam and owned by Thai Bev. So when they said it was so bad, the economy, that people are pulling back their beer consumption, that shows how bad things are, that you have to stop drinking so much beer. Yeah, so even shed a tear in my eye, but it's just that it reflects how bad the macro conditions were, and they only expect recovery probably middle of this year, maybe end of this year, but end of this year. We are a bit more bullish because we see export sector recovery, but that's what's happening to the consumer sector. That's why you say the consumer is stretched. Next slide. Okay, so finally for semiconductor. So of course, semiconductor, there's only 3 names. There's UMS, Franken, and AEM. We are neutral on this sector. So let me tell you why. Okay, so firstly, these names are very dependent on semicon equipment. So if you look at the semicon equipment, these are their customers, the usual AEM, Applied Materials, Lam Research, ASML. So these are their inventory, their customers' inventory. So the customer inventory is really building up. So when it builds up means then they will not need to order more. That's number one. And number two, they may not use the inventory that they have in hand that much too. So that's why what we worry about is that the inventory is rising quite sharply. So that's the first part of the issue that we worry. Then the second part is, the customer, I mean, I confuse everybody, but so like Applied Materials, has their own customer, right? So they don't use the machine. The machines that are used by Applied, which is UMS customer, is actually used by TSMC, your Intels, or whatever. So they are also cutting the amount of capex. I was a bit surprised, but in 2024 they're going to bring down again the capex. So end demand is coming down and inventory is high. So I mean, long term, of course, semiconductor is going to do well. Like I know AI is probably all NVIDIA that captures most of the value. So that's why we worry near term until maybe end of this year, the recovery we think will be delayed. Too much inventory and your end demand is also coming down. Next slide. Okay, so having said that, we'll just move on to the stock picks. Okay, so these days, before we do anything, we always check with AI first, right? Because analysts like 50-50, right? So anyway, if you look at this, I actually did a check. But so if you want to fact check anything, even when obviously US election or fact check everything, just go to Google and you can check. So this is what was mentioned by AI. This is not the research picks, but this is what was checked. This is their pick. They won't tell you what are the top stocks, but this was, I think, from our absolute 10, probably only ST engineering. But I think they are looking more into frequently mentioned. But jokes aside, I think for us in research, we actually AI very seriously. Because AI is a tool, or internally is also a weapon, because we are actually keeping track of how to use ChatGPT, generative AI, because we do not want to be like, if competitors have like, I don't know, if they use it and they have a missile or machine gun and we're still using pistol without using ChatGPT. So to us, we take the ChatGPT or generative AI track very seriously. So we are trying to incorporate as much as possible. Of course, now some people are just using AI and selling funds. I mean, that's not us, but I mean, just to take note of that. Next slide. So this is our model portfolio. We try not to move it too much. We only added like China Aviation. We'll talk about it later, and also Electronics. We took out CapitaLand, Escort. I think if you want, you can ask more, Darren, why. And then we took out Propnex. We cover a lot of stocks again, but if you have any questions, feel free to ask us. But this is just some of our model portfolios. We're not going for all out growth. We're not going for the highest growth, because again, it is supposed to be a portfolio. We try to balance it with a bit more yield, like FCT. You probably ask me why the upside only 1%, but because we're only going for the dividend yield. Because we are not going for the most aggressive names. So it's supposed to be a portfolio. And we have 10 stocks only. It is already very aggressive. And minimum, you should at least have 20 stocks in your portfolio. Next slide. Okay, that's the performance. We got hit very badly because in the first quarter of last year, anyone who was here, we actually took a position in Prime. But then of course the whole derating in office, so that one really shaved up a lot of the returns for us. And then we added in Propnex, so that's why the one that recovered some of it. Next slide. Okay, then in our previous slide, a lot of us asked a lot. We had some questions, why you are looking too short term. Can you look at some of the thematics? So okay, we give you a thematic theme. So as the title suggests, for the long haul. I like to do for the long haul because no after sales service, or the car left the showroom, you call me after 10 years, that's long haul. So don't ask me what the stock performed after 2 years, because only 10 years. Right? So anyway, if you're looking, so some of the teams out there, this is part entertainment, okay, but if some of the teams out there is digitalization, which is the true fact. If you, like most of us these days, when you're making payments, we hardly use cash. So if you want to pay the digitalization team, one of it is like PayPal. These are stocks that we cover. So if you want to pay digitalization team, cloud, all that, so these are the names for you, like PayPal, data centers, or even Amazon, because they are the ones rolling out. Then if you want AI, there's only one, there's like NVIDIA. You can try AMD, but I think because NVIDIA, what I think at least, NVIDIA don't have enough capacity. So that's why the AMD can sell some of the chips. But if NVIDIA's capacity is up, I'm not sure whether AMD can sell any AI chips. But anyway, then you have Microsoft, because they're going to roll out. If you want healthcare, then of course we have Raffles and so forth. Okay, this one, if you want a college fund. So I have a teenage kid. So if you want to build a college fund for your teenage kids, so you just want to buy, you want to invest in things that you know they're going to spend. So Spotify is definitely number one, better than Netflix. So you can live without you can live without Netflix, but most of the kids, you turn off the Spotify, they're going to beat you up. So you most cannot live without, so you might as well just put the money in the college, put that as your teenager college fund. I put elite commercial, which is very weird. It's a UK, but they're giving you 14%. And if you're going to have your kid studying in UK, then you must have put it there since they're going to give you 14% yield. And then Google, because of YouTube and so on. Then more on the if you want to buy business models, so if you want to be those investor, long-term investor where you don't care the short-term volatility, you want to buy who has the best model, who has the best economics, because the volatility, like so CapitaLand or not, like I think Darren will mention to you, most of the property companies we speak to want to grow up, not Jordan, want to grow up to be like CapitaLand Investment because it's asset like. Of course, they may not tell you directly, but most of them, everybody wants to grow up to be like CapitaLand Investment because it's asset-like model. You can just raise money and just give a few calls. I'm raising a fund, okay, if a couple of 100 million. I mean, I'm just exaggerating. Then, of course, locally, we have HRNet and TalkNet. Next slide. Okay, I know this one. Someone called me Mr. Comfort. Hopefully, it's because of Comfort Telco, not other things. But I was called Mr. Comfort before, but because I keep on promoting this stock. So we still think there's one more leg up for Comfort. Maybe, as the title suggests, repricing. So in the last 10 months, Comfort has really raised prices on taxi. If you're not noticed, okay. So what they've done is, number one, they cut the rental rebate. So no, Comfort Telco model is that they rent cars. So because of that, but they cut the rebates. They used to give discount of 15% to the drivers, then they cut it to 10%. Then later on, they have this platform called Zip, which is competing against Grab. They introduced a booking fee, 70 cents. So in the last 10 months, then recently they taxi raised rates. Then the fourth one was also, which doesn't benefit them, but the fourth one also, they also raised the booking commission from 5 to 7. So this is just the last 10 months. So obviously, Comfort not going to do that because if the taxi takings are not doing well, otherwise, there's going to be a long queue of taxi drivers standing out there going to complain. So they only can do that if the business is doing well. So that's one part. Then in the UK, which has been a real pain for Comfort, is starting to price up because there were bus driver shortages. You can see from the newspaper. I mean, you take the newspaper a year ago, you can see shortage of bus drivers. So they have to take on all these costs, and then now it's passing over. But anyway, as you know, they call me Mr. Comfort. I think I told this story many times, so I'm not going to run through. Next slide. So for Thai Bev, this stock has been pummeled. As you can see, 2023 is one of the worst performers, but we think there's still a recovery, mainly because of fiscal stimulus. We think Thailand is going to introduce a $14 billion stimulus on just one scheme itself. That means they're going to give every adult, I think maybe $300 Sing dollar. Of course, our CDC was bigger, but this is $300 to every 50 million people. I was only 2-3 million, but they're going to households, but they're going to give 300 Sing dollar to 50 million people. So we think this is going to stimulate the economy, and this is going to be good for them. Probably going to roll out in May. Why the share price may not have reacted, because there's a lot of debate whether this will go through. They also reduced taxes on alcohol. So you want to have a fun time, probably is a good time then. Then of course we think the macro, all these things, the macro should improve with tourism and so on. Next slide. Then of course, like we mentioned, Singtel, we like it. So there are 3 reasons. Number one, like I shared with you earlier, mobile prices are rising. But they are not standing alone with it. To give credit to the management, they are actually going to cut costs. They're going to do a very aggressive cost cutting. They're going to cut 200 million of costs per year for the next 3 years. Hopefully I'm not working there, but I mean, if you're working there, that is a lower cost. Okay, it's pretty evident. But we think most of it is going to be at Optus price, Optus level. Because if you look at this chart, I think we showed before. Optus spent a lot of money. They've been like having a great fun time. I know they spent like 10 billion of capex, but then your profit came down. I'm not sure how the maths work here, but that's why they need to bring down the cost. Partly to, the jokes aside, also because there's a lot of competition in Australia right now. I think there are like 40 to 50, like Circle Life, everybody probably got an email every day from Circle Life, but they got like 40 Circle Life there, so I'm not sure how they can compete. So that's why competition has been done, but they're going to do aggressive cost cutting. So that's why there'll be the second catalyst to the share price, a higher price. The third reason is monetization. So they got a 6 billion plan. They want to do like a Capital Corp mini-me kind of thing, because Capital Corp share price is so well, right? So they're going to also sell assets. So they have 6 billion plan, they've done 2 billion, so they have another 4 billion of assets to sell. So we still think that there's a few share price catalysts, and this is a huge, large cap which you rarely get multiple catalysts. Next slide. Then valuation, this is a mid-cap, no volume, but actually volume picked up. Okay, so hopefully nobody asked me that. But why we like it is because number one is cheap, like 80% of the market cap is in cash. And it's not like this company has been listed from 2007, it's been listed many years. And secondly, they are growing. So the last 5 years has been bad. I can see from this chart, but we think that the growth is coming back for this company because they got new customers. And then they're giving you high yield of 6%, and they're doing like 40 million share buyback, 40 million of shares share buyback. So your downside is protected. So we rarely do small mid cap, but I just think that it's very compelling because it's cheap growing and also high yield. I think that's it for me. I think we'll move on to next to Glenn on OCBC.
Thanks, Paul. Yep, so for our topic for the banks, among the 3 local banks, we actually picked OCBC. Several reasons why. Firstly, we look at their net interest margins. So surprisingly, I mean, I'm not sure whether most people know, but OCBC has the highest net interest margins amongst the 3 local banks. This has been for the last few quarters. So they don't really specify why or how, but I think just by looking at their funding costs, they managed to take advantage of the high interest rates, and they are able to sort of get this higher net interest margins compared to both DBS and UOB. And secondly, we also see their fee income. Their fee income is also recovering quite well. It reached the highest level in 4 quarters in the 3rd quarter of 2023. And they're also pushing quite heavily on their sort of like their refresh. So they keep talking about this OCBC refresh, where they managed to get this one OCBC. So it's something like where they are able to speak to each region within the group instead of individually having each company like sort of talk to each other. So that will also be able to grow their fee income and their wealth management income. And last but not least, their dividend yield. So their dividend yield is currently at an all-time high. I think we're looking at FY23, it will be around 6.6%. So, I think one of the reasons why their dividend is so high is because mainly due to also their CET1 being very high. So CET1, if you look at this chart here, sorry, doesn't mean go back to the dividend yield. If we push it all the way back to 2006, and you can see that it's actually, this is sort of a record high for OCBC. And we also see that it could possibly even go up higher, mainly due to their extremely high CET1. So their CET1 is the highest amongst the 3 banks. So even with their most recent acquisition of the Indonesian asset, it was quite a small amount, less than 200 million. We still expect their CET1 to come in around 15%. So we look at the optimal range for the banks. I would say on the high side, it's around 13%. So we take that as a sort of a 2% surplus. And that's how I came up with this figure here, where we look at the excess equity per share. So it's based on an optimal CET1 ratio of 13% and their current CET1 of 15%. Rough calculations, we're looking at around $2.49 per share. So I'm not trying to say that this is going to go all the way back to dividends, but they have to put that excess equity somewhere. So we could possibly expect even higher dividends going to the year end. So when they release their 4th quarter results, we could possibly see that, or even in the first half of this year. Yeah. So we do maintain a buy rating with a target price of $14.96 for OCBC. So that's all I have for the banks. I'll hand it back to Darren. Thanks.
Yeah, thanks, Glenn. So for FCT, we like them because their stable play, and we're aiming for the dividend yield, not so much the capital appreciation. So first of all, for FCT, their tenant sales continues to improve. Their tenant sales grew 7.4% year on year, and it's about 17% higher than pre-COVID levels already. So that's one point, growth in tenant sales. Another point is that right now their occupancy cost, which is at 15.6%, is below the 17%, which is their average level. So occupancy cost basically is the rental income that they pay divided by the tenant sales. So a lower occupancy cost will support kind of their negotiations going forward for higher positive rental reversions. And for SCT, they also do not have any loans that are expiring in 2024. So that's a good thing, as when you refinance loans this year, when interest rates peak, you expecting that you can expect to pay at a higher, as in refinance your loans at a higher rate. Yeah, so because of these few reasons, and one more, SVT focuses on essential services as well. So they have proven their resilience through COVID-19, and that's why we like them for their stability. Yeah, so that's why we have an accumulate, and it's in our model top 10 model portfolio. Yeah, next slide, please. Yeah, so for CLI, capital land investments, we like them mainly because of their recurring income streams, and this chart here is it shows their growth for their AUM, their real estate assets under management, as well as their funds under management, which is their funds that they manage under their listed and unlisted platforms. So you can see here for both platforms, they have risen about 5% compound on a compound annual growth rate. And right now, especially for their funds under management, it's now at about 90 billion. So they have about 10 billion of funds that are embedded and have yet to be deployed, that are ready to be deployed. And we expect it to for them to be able to kind of deploy in a environment this year, especially in the later half of this year, as when interest rates peak, and it will be much easier to deploy. As before, like perhaps last year when they were trying to deploy funds, when interest rates keep rising, it's hard to get a cost of capital for them and to kind of estimate the spread that they can earn on each investment. So, which is why it was quite tough to deploy funds for this. And going forward, we also expect the capital investments to have increase in events-driven income as all these transactions come back into the market, especially now that they have a 3 billion divestment target every year. And it's unlikely that they'll hit it this year because of the muted number of transactions, but we expect them to possibly hit it in 2024. Yeah, so mainly we like CLI for their recurring income streams and stable income. Yeah, so which is why we have a buy and a target price of $3.68. Yeah, so that's all for me. I'll hand over the time to Peggy. Yeah, thanks.
Yeah, elaborate a bit more on Keppel, why we still keep it in an absolute 10 model portfolio and still continue to be bullish on the company. Because as I mentioned earlier, that's asset monetization is the key word for them. And we think this year the asset sale will be front-loaded. Among the assets in the balance sheet that they can sell is they had about $4 billion worth of legacy REIT assets, which if those are sold, the 4 billion cash will come back to the company, come back to Keppel. So there's some cash free up that could be potentially distributed back to shareholders. The other assets that they could be selling also could be M1. We think that there's a possibility that they want to put that into a fund, under a fund structure, and they will continue to manage it. So while they do this asset sale, they lighten the balance sheet, but they still continue to be able to generate recurring income from the management. So they have doubles bite on the cherry. So this is their target for the asset monetizations, which they expect to achieve a cumulative 12 billion by 2026. So there's another 7 billion to be achieved from this year to 2026. We think a lot of that will happen in early part of these 3 years. So we look forward to this asset monetizations from Keppel. Okay, the next one I have on Absolute 10 is ST Engineering. ST Engineering is a very unique position. It's a defense play in the Singapore market, the only one that you can find. The other thing that makes them very attractive is, which probably very little known, is that they are the largest independent aerospace MRO operator in the world. Okay, why is so important for being the independent MRO? You see, a lot of the MRO operators in the world, the top one, you Google, you ask about GPT, they will list all the equipment makers like the GE, the Rolls-Royce and so on. But the only like 2 are independent MRO operators. One is ST Engineering, the other one is HAECO, the Hong Kong company. Being independent means they can do businesses with every type of OEM manufacturers. They can do all sorts of equipment. They can choose to do any kind of equipment. And according to Precedence Research, this is the growth for aircraft MRO market. This is on a steady state, with not considering disruptions that we have seen lately. Okay, since I started covering ST Engineering last year, there's been a few things that happened in the market. Pratt & Whitney, the engine has issued, right? They had to some of the engines have to be put down for checks. There's some white powder surfacing on the engines. And second thing is there's small little incidents here and there, but the latest one, of course, is the B737 MAX 9 aircraft. So when the aircraft grounded the airplanes, the first thing they do is have send all the airplanes to the MRO shop for checks, for turret checks and repairs. So there's creating a lot of demand for MRO operators and very tight hangar capacities. So we think ST Engineering stands to benefit from this, as they have MRO operations around the globe, in US and in France, and of course in Singapore and in Asia, including China. So that's the reason why we think ST Engineering might be very, very busy this year. Okay, China Aviation Oil. First thing to take note is the Chinese carriers have turned profitable in the third quarter. That means their customers. Why important is that when the customers are profitable, they have cash flow coming back, they are able to spend more in adding flights. So we think the volume for air travel from China for the international flights will pick up. For China Aviation Oil, they sell the jet fuel and for international flights from the Chinese airports. They are very strong in 5 big airports in China. They now potentially can expand this to another 5 bigger airports. So there's the growth to be expected. And compared to the international passenger traffic volume in China, it's still about 45% below 2019 level. So there's another 100% doubling of the capacity that can come through from China. So with that, we think CAO is a beneficiary. As the demand comes up, they are able to supply more fuel to the flights flying in and out of China internationally. That's all for me. Pass on to Mel for the recent initiations. Thank you.
Thank you, Peggy. Hi, I'm Mel, the REIT analyst. I'll be going through the recent initiation. This is one of our college fund pick, Elite Commercial REIT. It's a UK commercial REIT with very stable income from many government-backed tenants, such as the Department of Work and Pension or National Defense. We like the REIT because of its cheap valuation. It's now trading at 14% dividend yield and 0.5 times price to NAV, which we believe is very attractive. The huge discount is mainly because of the high gearing. As of December last year, gearing was at 49.6%. However, they have been actively deleveraging. They recently launched a 28 million preferential offering, and we expect them to use all the proceeds to pay down the debt. And post-preferential offering, gearing is expected to drop from 49.6% to 43.5%. And this will strengthen their financial position and also enlarge the debt headroom from 3 million to 56 million. And which enables them for future redevelopment plans, such as student accommodation and data center. They are also very committed to its divestment plan. There's 3.4 million assets divested with 4% above book value, and 2.4 million assets is ready for the next round of divestment, which is able to bring the gain down by 30 bps further. And researchers also expect inflation in UK to lower from 3.9% last year November to 2% within 4 months, and that is a huge reduction from the 11.1% peak. And therefore, we expect Bank of England to have a rate cut soon. Overall, we think the worst for Elite Commercial REIT has already passed, and we initiated coverage with a buy recommendation and target price of 0.36 pence. This is Far East Hospitality Trust. It's a pure-play Singapore hospitality REIT with 9 hotels and 3 service residences. We like the REIT mainly because we believe the momentum is very likely to sustain, as Darren mentioned, especially with the return of Chinese tourism and recovery of flat capacity. So on a whole year basis, we expect RevPAR to bounce back to 97% of pre-pandemic level, and anticipating a line of MICE events in FY24. We expect NPI to be strengthened for service residents and thus driving DPO growth by 4.2% in FY24. Far East Hospitality REIT also has a very unique master lease agreement, which consists of a fixed component and a variable component. Fixed component alone in FY22 generated 77% of the revenue and translated into 4% dividend yield. Yeah, this is able to help the REIT protect against macroeconomic uncertainty. Far East is also one of the least geared as REIT with 32% gearing and 900 million debt headroom. They are eyeing acquisition in Japan, ticket size roughly 70 to 80 million, and we expect to generate a positive spread of 2%. And there's also 18 million incentive fee post-divestment of Central Square. And Far East plan to use it to cushion any negative impact brought by the interest rate hike, and targeting a whole year FY23 dividend yield of 6%. And as such, we initiated coverage on Far East Hospitality Trust with a buy recommendation and target price of $0.79. Yeah, that's all for me. I'll hand over back to Paul for conclusion.
Okay, thanks, ma'am. So before I go to Q&A, just some quick conclusions for those who have taken a nap. So firstly, we still think global growth is going to be slow. So this is just the roadmap that investors should think of for 2024. Interest rate cuts will cap any growth downside, and we think it would cause a revaluation of assets. So asset managers could be CapitaLand or even ESR, I guess. We could see a rebound because if investors are comfortable and they know where interest rates are going to land, then you could see more transaction activity. So this will benefit a lot of asset managers. These are our REITs, I think, our Conglomerates, Telcos. So I think I'll hand it over, and then we'll take like questions from the floor, then we just move on to the online things which we